Hello, very good morning to all and welcome to a brand new week. I'm Kelvin here again, the Senior Market Analyst of OANDA Asia Pacific. Very good morning to today's Daily Dose of Market Insights. Today will be Monday, the 25th of March, 2024. All right, so before we start our Daily Dose of Insight, let's take a look at the disclaimer slides first. All right. Leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product, as well as any forecast, prediction, or projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. All right, so as usual, before we jump straight into the short-term technical outlook of the various broad-based cross asset classes, ranging from the major stock indices, the major FX pairs, as well as spot gold, XAU/USD, and oil, crude oil, West Texas oil. We will have a recap of what has taken shape last Friday in terms of the performance of the broad-based market, and as well as any key events or economic data that has been released over the weekend, or even as well as early today's Asia session. All right, so let's start with the performance last Friday first in terms of the last start of the stock market. What we could see in the stock market over here is that the European benchmark stock indices continue to actually outperform against the rest of the world and even against the US market. So what we could see in my screen over here, okay, let me share you my screen. All right, so what I could see over here is that the German 30 managed to add 0.14% on Friday, and as well as if you look at the US market, it's rather lackluster. So that's actually came within our expectation. For those who actually follow our market daily dose of markets on Friday, we will actually do have a short-term technical bearish bias on the major US stock indices because there are some signs of overbought. Indeed, the SPX actually managed to close down negative 0.14% on Friday. The Dow Jones Industrial Average negative 0.8%, followed by the Russell 2000, the worst performer, negative 1.27%, and the Nasdaq 100, rather a minute gain of 0.10%. So if you look at the heat map of the S&P 500, okay, let me share with you all. Yeah, this is the heat map on last Friday. So what we could see on the heat map on the S&P is that almost a sea of red over here. The one that is only kind of leading or holding the fort as usual will be the 7 mega cap stocks. Okay, the 7 mega cap stocks over here where we see positive performance in Apple 0.53%, Google positive 2%. Then so kind of a AI market leader, Nvidia, gained positive 3%. All right, so net overall, right, what we could see is that yes, the mega cap 7 stocks is holding the fort at the point in time, but the rest of the component stock inside the S&P 500, there are actually more reds than green. So in terms of the market breadth, performance is more skewed towards the bearish side rather than the positive side of things. And also overall, what we could see over here is the dollar strength came back into the picture as well. So you look at the dollar index over here. Okay, so this is the dollar index. So what we could see over here is that the dollar index for sure managed to actually see two consecutive day of strong performance on Friday and as well as Thursday, clearly surpassing the 103,670 level. Okay, and also above this level is important. Why? Because above the 200-day, it is also the 200-day moving average, the 20-day moving average, and as well as the 50-day moving average. So the next step over here is that we may start to see further potential strength, at least in the short term, to test the next intermediate resistance level on the dollar index at 104.85 level. So if you look at the daily RSI, also pretty much positive, hasn't even hit the overbought region yet. Okay, so i.e. supporting this bit of what I call at least a short-term dollar strength coming back into the picture. So with that short-term dollar strength coming back into the picture, that could actually also translate to a bit of a risk of behavior or a risk of feedback loop into the markets. And do not forget over here is that a certain component, we call it, we do have a significant number of, we call it revenue from the S&P 500 companies that is being derived overseas. So if we start to see dollar strength coming back into the picture, their overseas revenue will be hampered as well if we do the conversion back into a dollar into the home country, which is in US. So that's what actually explain the lackluster movement on the S&P 500 due to this dollar strength that is coming back into the market. All right, and also net overall, if you look at this, is the daily 1 month rolling performance chart based on the dollar against the other major currency as of right now. So we could see over here is that very clearly we do see a spike up in the dollar strength, especially on last Thursday. Why? Because last Thursday, those who have followed our market daily dose is due to actually one surprise move, I would say. That's more major because the Switzerland National Bank, which is the Switzerland Central Bank, the SNB in short, surprised the market by jumping ahead the gun from the Fed. That means they actually cut ahead of the Fed by this. They're pretty much concerned about the Swiss strengthening, especially against the euro. So what we start to see over here is that the dollar Swiss starts to actually spike up, and with that dollar Swiss spiking up, it actually created this kind of what I call dollar strength across the board, all right, because it's a major currency, right? And with the acceptance of dollar yen, why? Because dollar yen, there's actually risk of intervention by BOJ under the instruction of the Japan Ministry of Finance at a key resistance level at 151.95, which is actually didn't break on Thursday and on Friday, despite a close test of this level. And what we could see very interesting over here is that this little line here, the red one, which is in dollars versus the China offshore yen CNH. So we know that the CNH over here has been pretty much in a tight steady trading range environment in the last 3 weeks, except that it starts to actually spike up on last Friday. Okay, so this spike on last Friday is being actually engineered by the China Central Bank to actually lower down the China yuan fixing against the dollar. That means they allow the Chinese yuan to actually depreciate against the dollar due to the spike up in that dollar strength on Thursday that is being triggered by the Swiss central bank. So what I could see over here, right, in the my chart, okay, this is the dollar CNH chart. Let me show you in a couple of seconds, a bit slow. Yeah, this one over here. All right. So this was the spike up on last Friday back towards the key medium-term pivotal resistance at 127.65, 126.75, pardon me, 126.75. But very clearly, right, it now starts to actually reintegrate back above the 200-day and the 50-day moving average. All right. So indicating to us there's some signs of bullish momentum coming back into the dollar CNH exchange rate. That means, i.e., dollar strength being seen in the Chinese yuan being engineered by the PBOC, which is the China Central Bank, that actually allowed the Chinese yuan to trade weaker on last Friday due to the surprise move on the SMB, the Swiss franc. Okay, so one thing for sure, right, this is the rate we got to monitor. Why? Because if the Chinese authority allows the CNH to actually get weaker, that means dollar strength going to trade upwards. Okay, going to trade upwards. Okay, over here, there could be a risk of what I call potential currency war. That means what we could see over here is that other exporters attempting to actually reduce their currency or doing kind of pseudo devaluation on their currency against the dollar. So we start to see another layer of dollar strength spreading globally, not even the majors, and start to spread to other emerging market as well, which is pretty much dependent on their exports. Yeah. So with that, right, that could also trigger another bout of a round of what I call risk off behavior into the market as well, which could actually dampen the positive animal spirits that's being seen in the global benchmark stock indices. So the one that is definitely will first hit for sure will be the China proxy, because the China stock market is also cannot have would potentially face this kind of negative feedback loop due to a weaker CNH, and that's also explained why the Hang Seng Index was relatively the underperformer on last Friday. All right, so this is the intermarket relation that took shape on last Friday due to the dollar strength, and as well as this dollar strength leading to CNH weakness, Chinese yuan weakness, that could actually trigger a potential currency war. Okay, now what we could see over here is in terms of economic data on last Friday, there is actually none economic data, but in terms of events wise, we start to see geopolitical risk tension coming back again due to this Russia-Ukraine ongoing conflict that took shape on last weekend, in fact on Sunday, where Russia stages a major airstrike on Ukraine. All right, and one missile enters into the Polish airspace. So this is with this kind of ongoing geopolitical risk premium, at least in the short term, it could actually benefit oil prices. All right. Then this is the current data that is being shown so far. And lastly, before that, actually early this morning, okay, let me expand my screen so that you guys could see. Okay, so early, okay, why is it so small? Yeah. Okay, so this morning, Bank of Japan actually released at 7:50 a.m. Singapore time. It released their monetary policy meeting. That was the meeting that was concluded on last Tuesday, where actually they did a historical milestone by removing the negative short-term interest rate that is in place since 2016, and they hiked for the first time since 2007, and as well as scrapping off the 10-year JGB yield curve control program on the 10-year JGB yield. So the minutes itself are actually done surprise anything. There's no major surprise, except that there's actually a rising likelihood of hitting inflation target. Okay, so there's signs of what I call confidence that the Japan economy is no longer, I would say, low odds of slipping back into a deflationary risk spiral again. So that could actually kind of stating that yes, even though the Japan BOJ starts remove short-term negative interest rate, it may not be only a token hike on last Tuesday, so they could actually continue to hike again, given the fact that the BOJ officials among themselves, they're thinking itself that they are pretty much confident of Japan not slipping back into a deflationary spiral, and if inflation data continue to actually spike up on the upside. And do not forget over here, like I mentioned earlier on, given this ongoing geopolitical risk premium that is out in the Middle East, in Russia, Ukraine, and around the Red Sea, where the terrorists going to attack oil tankers, so that could actually maintain higher oil prices going forward at this level. That means there's low chance or low odds of high oil prices slipping back below $60 US dollar per barrel, given the current what you call geopolitical situation that we are looking at it right now. So with higher oil prices, there could be elevated inflation coming back into Japan due to a weaker yen. So that could actually prompt BOJ to actually step up their game. All right, because they are being late in this we call it monetary policy, global monetary policy, we call it normalization. All right, so with that, right, that actually sum up the key events that has taken shape so far. Let us now jump straight into the short-term technical outlook. All right, so let us start with the stock indices first. All right, okay, Asia Pacific indices, Hong Kong 33, which is the Hang Seng Index. So Hang Seng Index over here is that it actually broke down on last Friday, okay, and broken down below this minor ascending trend line or minor ascending channel that I drew from the low of 22nd of Jan this year. So overall, I could see, right, that means this whole move, right, from Jan, okay, for those who keep on following our daily dose, our market insights, I've been stressing over here is that whatever bounce that we see on the Hong Kong 33 index is more or less a corrective rebound within a major trend that is still in place since 2021. All right, why? Because it's continued to trade below the 200-day moving average. So if you look at the daily chart over here, Okay, it's been trading below the 200-day moving average, and there's this long-term circular ascending trend line channel that is in place since 2021 high. It's been trading within this trend, and also based on the subset within this long-term bearish circular trend, it's going to trade within a major trend line channel, a major descending channel, pardon me, since 27th of Jan 2023 last year. So net, right, overall, whatever bounce that we see at the start of this year is just corrective in nature. All right, corrective in nature. And if you look at the daily chart, for sure, it clearly broken down below this minor ascending channel support, and this could be a bearish flag breakdown. Okay, bearish flag breakdown. So this is a bearish flag instead, rather than the start of a major uptrend in the Hang Seng Index or the Hong Kong 33. And also the RSI has started to break down below a parallel ascending trend line support that I drew from the start of January as well, after refusing to break above a parallel resistance at around the 62 level. All right, over here, one time, two time, three time, and it broke down on last Friday. So indicating to us there's a resurgence of medium-term bearish momentum coming back into the Hong Kong 33 index. All right, so overall weakness ahead, potential weakness ahead on the Hong Kong 33 index. That means, i.e., there's a high chance that this corrective rebound phase has more or less been ended since the start of this year. So with that, right, also price action this morning managed to actually stop at the 20-day moving average. So far, it didn't break above it in the last 2 hours as we are speaking, as before we speak. So I don't want to put it so tight, right? So this will be the first resistance to watch at 16,650. I don't want to put it so tight as my short-term pivotal resistance for today. I'll still use this very clear key resistance level, which was the inverted V shape, or that bearish, the tip of that bearish, minor bearish reversal that was triggered on last Thursday, 16,960. So I'll be using 16,960 as my short-term pivotal resistance level, still maintaining that bearish bias, short-term bearish bias on the Hong Kong 33. First support level to watch 16,135, which is confluence with the 50-day moving average. A breakdown below it exposes the next near-term support level at 15,730. Only hourly close above 16,960 will invalidate today's short-term bearish bias on the Hong Kong 33 index to see another round of choppy up move or choppy corrective push-up. Retesting the 13th of March minor swing high area at 17,230. Above it, expose the long-term, the key 200-day moving average. Pardon me, the key 200-day moving average, acting as a also confluencing with the graphical resistance level at 17,570. Okay, 17,570. Okay, so before we jump straight into the Nikkei 225, right? Let me expand my screen first, so that you guys could see. Right, good. So Nikkei 225, last Friday, we also flipped to a bearish bias, all right? And the price action of the Nikkei 225 continued to inch down lower with our set or reference short-term pivotal resistance at 41,000/41,175. And it's now fast approaching our first support level at 40,050, but it haven't broke below 40,050 yet, so I don't want to tighten the short-term pivotal resistance to so tight. So I'll still maintain that short-term bearish bias using 41,000/41,175 for this potential minor corrective decline to play out on the Japan 225, aka Nikkei 225. A break below 40,500 level will expose the next near-term support level at 39,990/39,840, which also confluence with the upward sloping 20-day moving average. So what we could see over here, after a very strong multi-month up move in the Japan 225, this Japan 225 now is actually ripe for a potential bearish mean reversion corrective decline scenario, right, to actually retrace back to the moving averages. All right, so first moving average to watch will be definitely the 20-day moving average in the short term. So if you do the Fibo retracement of the last push up from 15th of February, 15th of March low, okay, this 39,990/39,840 confluence with the 38.2% and 50% Fibo retracement. Only hourly close above 41,175 over here will invalidate this potential ongoing corrective mean reversion decline scenario to see the continuation of the impulsive up move to expose the next resistance at 41,475, 41,660. Above it sees 41,800 next. All right, German 30. So the German 30 continue to be the one that is continue to trade within a very nice we call it uptrend, minor uptrend phase. As you could see, prices going to trace higher high, higher low within this minor ascending channel that I drew from the low of 14th of February. So now attempting to already hit the first resistance at 18,340. The RSI doesn't show signs of bearish divergence. Going to see higher high in line with the price action. All right. So with that, I will tighten the key short-term pivotal support for today, which corresponding to last Friday low, minor low at 18,200. So tighten it to 18,200 short-term pivotal support for today to maintain this ongoing short-term bullish bias on the German 30. Above 18,340 exposes the next intermediate or near-term resistance coming in at 18,500, which is close to the upper limit of this minor ascending channel as well as a Fibo extension cluster level. Only an hourly close below 18,200 will put this short-term bearish bias in jeopardy, potentially kickstart a minor corrective decline. First support level, next support level to watch will be at 18,050, followed by 17,900, which actually correspond to the upward sloping 20-day moving average. Okay, now US benchmark stock indices. Let us start with the Dow Jones Industrial Average. So the Dow Jones Industrial Average broke below the first support level that we highlighted, 39,640, now turns into a pullback resistance. All right, so the next support level to watch will be at 39,270. So we could see over here is a potential mean reversion corrective decline that is playing out as well on the Wall Street 30, that is attempting to actually retrace that up move to actually retest the upward sloping 20-day moving average. Okay, which now confluence with the next support level at 38,990. But with the RSI now hitting the oversold level on an hourly basis, potentially after last Friday's minor steep sell-off, there could be a risk of a snapback rally or a minor pullback first before resuming its potential down move on the US Wall Street 30, because the short-term bearish bias remains on the downside potentially. So what we could see over here is that if we do the Fibo retracement of last Friday's we call it sell-off, we have the 61.8% level at 39,830, which is also confluence with that minor swing low area, now turns into a pullback resistance as well that I draw graphically over here. All right, so this level was being tested early on the Friday session before it broke down and give rise to that steep sell-off in the later part of the US session on last Friday. So for sure, this has some clear, significant psychological reference, and as well as the Fibo retracement of the golden ratio of 61.8%, solidifying it. So with that, pardon me. So with that, I'll be using a Titan key short-term pivotal resistance for today on the US Wall Street 30 at 39,830. So any potential bounce, minor bounce, given the fact that the RSI is the oversold area, any bounce that didn't break above 39,830, I will still maintain that short-term bearish bias on the US Wall Street 30. First support level to watch for now will be at 39,270, followed by the next support at 38,990. Only an hourly close above 39,830 will invalidate this short-term bearish bias on the US Wall Street 30 to resume its impulsive up move, with the next resistance coming in at 39,990. Above it exposes 40,245. Next, Nasdaq 100 continue to trade sideways on last Friday, but below the short-term pivotal resistance level at 18,470. So I'll be still using 18,470 as my short-term pivotal resistance. RSI not that great, managed to shape that bearish reaction below this former parallel support, turns into a pullback resistance. And what is shaped over here is that it shaped a higher low, okay, on last Friday, right below this pullback resistance. So net overall, upside momentum doesn't seems to be appearing in terms of the probability. That means there's low probability right now as being depicted by the hourly RSI behavior that we are seeing on the Nasdaq 100. So with that, still maintaining that short-term bearish bias on the Nasdaq 100 using 18,470 as a short-term pivotal resistance. First support to watch 18,110, which correspond to that 20-day moving average. A breakdown below it exposes 17,940. which also crossed 17,940, pardon me, which is defined by the lower boundary of this bearish ascending wedge configuration that I drew from the low of 22nd of February. Only an hourly close above 18,470 invalidate this short-term bearish bias to see the continuation of the impulsive up move. Next resistance to watch, 18,620 level. A break above it exposes 18,880 next. All right, so overall, what we could see over here is that we still have a short-term bearish bias across the board for the major indices that I highlighted earlier on, except for German 30. FX market now. Okay, so FX market, let us start with the European currency first. So European currency, the euro dollar, pardon me. So euro dollar, if you recall, we flipped to a bearish bias on last Friday, and it almost hit the support level that we highlighted, 1080. So first support that we highlighted was 10840, then followed by 10880, 1.080 level. So 1.080, pardon me. So with that price level, we hit this support level, RSI at oversold region. So what we could see over here is that it's now attempting to do a snapback minor corrective bounce as well. First resistance to watch over here, definitely this will be the line of pullback, 1.0840 level, which is so confluence with the bunch of the 50 and the 200-day moving average, acting as a similar resistance level as well. So, but I don't want to put it so tight at 1.0840. I will actually tighten it to 1.0870 instead, which is the close to the 50% retracement of that sell-off that took in shape on last Thursday. Okay, 50% people retracement, and as well as the 20-day moving average acting closely as a similar resistance level as well at 1.0870. So as long as any potential, we call it a snapback, we call it bounce over here, that didn't surpass 1.0870 short-term pivotal resistance for today, we will still maintain that short-term bearish bias on the euro dollar. First support level to watch now will be 1.08 1.080 followed by 1.0760, all right, level. Okay, on the euro dollar, only an hourly close above 1.0870 will negate this short-term bearish bias to see another round of choppy movement to expose the next near-term resistance level at 1.090, then potentially followed by last Thursday minor swing high area at 1.0940. Very similar on the British pound as well, the sterling dollar. Okay, so the sterling dollar managed to actually came down and now hit the 200-day moving average before trading sideways over here. All right, at 1.2575. That's what low on last Friday. So what we could do over here is we will still maintain that short-term bearish bias, but with a tightened key short-term pivotal resistance right now. So taking into account of last Thursday sell off to last Friday minor swing low. So the Fibo retracement of where it stopped at the 50% confluence with the 50-day moving average also acting as a similar resistance at 1.2690, and also this 1.2690 also confluence with the pullback resistance of that former minor ascending trend line. This is dotted green from the low of 14th of February 2024. So that is the former minor ascending trend line turned into a pullback resistance. So all three level, actually all three different elements confluence at the 1.2690 level. Okay, so I'll be using this 1.2690 level as my tightened short-term pivotal resistance for today to maintain that short-term bearish bias on the sterling dollar. For sure, first support level to watch will be last Friday minor swing low area at 1.2575, which will correspond close to the 200-day moving average. A breakdown below it exposes 1.2540 support level, which is the minor swing low of 14th of Feb and 15th of February. Only an hourly close back above 1.2690 will negate this short-term bearish bias to see a further squeeze up towards the next resistance level at 12730, which corresponds to the 20-day moving average. Above it exposes 1.2820, which is the minor swing high of 14th of March and very closely last Thursday minor swing high area as well. Okay, so that's for the sterling dollar. So now let's go to the Asia currency. Aussie dollar came down and as expected and hit the support level that we highlighted on last Friday. So last Friday we flipped to a bearish bias. So I could see right now on the Aussie dollar, there was actually a very clear bullish divergence today, and price action bounces off. And where it bounced off from the this kind of minor ascending channel that I drew from the low of 14th of February. Okay, over here it bounced off from there, but still remains resisted by these three key moving averages: the 20-day, the 50-day, and the 200-day, acting as a resistance just right below this last Friday minor swing high area that triggered that sell offer at 65.60. So I'll be flipping to a neutrality stance given the mixed elements on the Aussie dollar for today, neutral between 65.60 and 65.10 for now. Okay, unless we see an hourly close below 65.10, then we would revive our short-term bearish bias on the Aussie dollar with the next support level to watch will be at 64.80 followed by 64.40 level. So what 64.40 is in fact the key minor swing low area of 14th of February. All right, dollar yen. So dollar yen, very interesting. If you look at the daily chart, right, it got rejected 3 times, 1, 2, 3, 4 times in a row last week after BOJ announcement. So all the 4 rejected at 151.95 level. Okay, 151.95. This is the upper limit of the major resistance. Or it rejected, it formed bearish reversal, bearish candlestick pattern on a daily basis. Bearish shooting star, bearish hanging man, and bearish spinning top. So what we see is that the bulls, right, is getting lesser and lesser brave to actually push that 151.95 level, because it's technically is a major resistance, and it also form a recency bias of a fear of BOJ real intervention, because the previous real intervention that is being publicly announced was actually made on 21st of October, right at the 51.95 level, where the BOJ, under the instruction of the Ministry of Finance, took the duty to actually sell dollar, buy Japanese yen. So that's why you see the steep dollar yen sell off. So as and when we're going to come towards this level, there's much more verbal intervention, and there was also a slight subtle verbal intervention on last Thursday as well by the Ministry of Finance Minister, right? But in terms of the price action rise, we know that the bulls are a bit hesitant at around is hesitant at the 151.95 major upper limit of the major resistance zone. So with that, right, with the bearish candlestick that was formed on last Friday, we will be flipping to a bearish bias for today, at least in short term, for kind of the range trading. 51.95 bearish bias. First support level to watch will be at 150.30, which was on last Thursday minus swing low 150.30. Only a break below 150.30 may expose the next near-term support level at 149.50 / 148.90, which confluence with the 20-day and the 50-day moving average. However, if you see a pierce up above 151.95, then that major resistance at 151.95 will be in jeopardy, potentially exposing the next near-term resistance in the first step at 152.80. So that's for the dollar yen, flipping to a short-term bearish bias due to that bearish candlestick pattern that was cited on a daily basis on last Friday on the daily chart. Now, with that, let us take a look at spot gold. So spot gold came down as expected as well due to in general dollar strength. So what we could see over here, it do have a negative feedback loop on gold, because gold and dollar trade inverse tends to move inversely. So XAU/USD on last Friday, we flipped to a bearish bias for that potential minor corrective pullback. So it hit the first support level before bouncing up on this Asia session, morning session. But right now it starts to show lackluster pattern again after that what I call hourly gravestone doji, followed by a negative price action on the short-term basis, on hourly basis. So for sure, we know that price action is getting very lackluster again on the spot gold XAU/USD. So no change. I don't want to put it so tight. Okay, so this could be the first resistance level to watch for today. Okay, but I don't want to put it so tight at this level here, at this 2180 as my short-term pivotal resistance. So I will still be using 2192 as my short-term pivotal resistance level. So any potential whatever bounce that didn't break above 2192 will still maintain that short-term bearish bias. First support level to watch 2160, break below it 2147, 2146, which is the minor swing low of 18th of March and 19th of March over here, and also confluence with this upward sloping 20-day moving average as well. Okay, so only an hourly close above 2192 will invalidate this short-term minor bearish corrective pullback bias on spot gold XAU/USD to see the continuation of the bullish impulsive up move to expose the next resistance level at 2230. Okay, lastly, WTI crude oil. So crude oil price continue to benefit from the rising geopolitical tension in Middle East, and as well as the heightened heightened tension between Ukraine and Russia over the weekend. So what we could see over here is that 8060, which is our short-term pivotal support that we highlighted on last Friday. Indeed, this level is a key support level. Why? Because on last Friday, it came down and it staged a bounce back right above the 8060 level. So it tested one time, two times, three times. So this level 8060 for sure is an important level for the bulls to maintain its bias. So 8060 short-term pivotal support still maintain that short-term bullish bias on West Texas oil. First resistance 8230, followed by 8320, which is the close to the minor swing high area of last Friday. Only an hourly close below 8060 will see the extension of this minor corrective decline to retest 7880, which is the 200-day moving average. Right now, that's pretty much sum up for the short-term technical outlook across the broad-based asset class for today. So before we go, what are the key economic data to look out for throughout today's session? So in terms of the European session, very quiet. There's no key data coming out. So except for ECB officials speaking, so ECB President Lagarde will be speaking at 6 p.m. Singapore time later today. Then thereafter at 8:25 p.m. Singapore time, before the start of the US session, you have Fed speak by Fed official Bostic. Then after that, throughout the session will be a pretty much quiet session. This one not very important data. It's just a state. Okay, Dallas Fed manufacturing index, and you know that the manufacturing sector in US is not significant. And after that, followed by 10:30 p.m., we do have another Federal Reserve official speaking, Fed Cook speaking at 10:30 p.m. And then thereafter, we do not have much key economic data out in the US session. So with that, that pretty much sum up for today's Daily Dose of Market Insight. Thank you for your time, and I wish you all a great day ahead, and we shall speak again tomorrow. Thank you.